became a member of the European Union in 2004, leaving behind its communist past. Life was improving for ordinary people, and the economy was doing well. Then, the financial crisis hit. In late 2008, nervous investors began to pull out of emerging markets, and Hungary was one of them. Hungary's currency, the forint, began to plummet.
Hungary has a very high level of government debt, about 70% of GDP, and very high level of external debt, over 100% of GDP. So in a situation where at the global level investors want to reduce the amount of debt that they're holding, a country like Hungary, which has very high levels of debt, is vulnerable to the global crisis.
Ordinary people soon found themselves in trouble. During the good years, many Hungarians had taken out mortgages and other consumer loans in Swiss francs or euros to take advantage of lower interest rates. But as the forint lost value, those households and businesses were saddled with sharply rising debt payments.
What's going on in Hungary is not unique to Hungary. We are going through a global economic crisis. We're seeing huge dislocations. And even countries like Hungary, which admittedly did some pretty silly things in terms of how they started spending their money and money they didn't have and that they borrowed too much. Since about 2003, I'd say, but certainly since 2006, Hungary has been doing a lot of the right things. The problem is time just ran out.
Faced with the prospect of a full-blown crisis, the Hungarian government turned to the IMF and the European Union for help. A support package totaling about $25 billion was approved.
The IMF and the other institutions need to be congratulated for the speed and the pace at which they actually came in and stopped what could have been a real disastrous situation in Hungary and throughout the region. The IMF can sometimes be criticized for putting on too harsh conditions on the terms by which it dispenses funds. In this case, they did the right thing with the other institutions without putting restrictions on that might have made the situation worse.
The main goal of the IMF program is to restore investor confidence in Hungary and return the country to healthy growth.
The core elements of the program are a strengthening of fiscal policies, the putting in place of a bank support package, and monetary and exchange rate policy that is geared at price stability over the medium term and preserving financial stability. So on all three elements, important progress has been made.
The economic plan also aims to protect ordinary people from the fallout of the crisis.
In a country like Hungary, where government spending as a share of GDP is the highest in the region and among the highest in the world, social transfers are already at a very high level. So going forward, we think it's important to improve the targeting of these social transfers. In other words, make sure that it's really the most vulnerable parts of society that benefit from the social transfers. And so, for example, pension benefits were reduced, but they were reduced in a way that protects the poorest pensioners.
How quickly the country is able to recover will, in large measure, depend on the global economy. Hungary is a big producer of cars and machinery, and the global demand for these exports is still falling. But with the right policies, the country will pull through.
The most important thing is that the government implements the program. I think that as long as that happens, the international community will be willing to continue to support the program. And this provides, I think, the best chance for Hungary to weather its current difficulties and to weather the global downturn.